Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming directly from ematotrade.com. Let's take a look right into the gold market right now, trading last at 1905.60, up about 70 points. It's all over the place this morning. Silver is at 2804. We have been testing the average price of 18.99 that you see here for the week. The daily average for today is 1905, and you can see that since last night we traded towards this weekly average of 18.99 as we came into this week. The daily average, by trading below, activated a bearish trend or price momentum. The target was completed, and at 4:30 a.m. last night, the market activated a bullish weekly trend momentum and negated this daily bearish trend momentum. By the market trading through the weekly and the daily average of 1905 now, we pretty much have activated a weekly and a daily bullish price momentum. So let's take a look at silver here. The silver market has penetrated the weekly average price, and by trading above it, it's activated a weekly bullish trend momentum. The initial target is that 28.21, which is the daily average price, and we need to close above that to activate a weekly and a daily bullish price momentum. So the silver market is in a neutral zone, basically, neutral to bullish, and will activate a trend momentum on a close about 28.21. So we don't have any day trades today, it seems, using the VCPMI in the gold or the silver market, as the market is looking to establish a trend momentum, a bullish trend momentum or a bearish trend momentum. By trading below the average prices here, it's pretty much 50-50 standard deviation, and we watch and see the price reach the extreme above or below the mean in order to activate a trade here, based on the AI used in the variable changing price momentum indicator. I want to take a look at the daily chart here for a minute, because we seem to be really kind of breaking out of this uptrend channel here that was established back in March the 8th at a low of about 1673, and the upper end of this range on the weekly sell to level is 1939. So we can see for the rest of the week, really, this target's potentially being completed, and it would coincide with the harmonic alignment of the sell to daily of 1930. So we're entering what the AI begins to identify as a high probability area where potentially supply can come into the market. So it's a fairly quiet market here that is trying to define the handle of 1900, and I think the fundamentals of the market right now, again, are building up to be a pretty bullish picture. Fundamentally, when you talk about the shortage of supplies, it's becoming, pretty prominent, more pronounced, you might say, in the metals markets here, that is beginning to attract, obviously, buyers, as you see the price now trading above 1900, 1906. The silver market, obviously 28.50 seems to be an area of resistance that needs to be overcome in order to accelerate to the higher fractal in price. What I'm doing here personally, and what I'm recommending my traders in the live trading room, to hold on to your long positions. And hold on to your long positions, and let's just watch the market here for a little bit. We have let me just want to double check here. Testing 1 2 1 2 testing 1 2. I want to make sure that we have the sound ready. Testing 1 2 in the live trading room. We're taking a look at gold trading last at 1906.70, up 160, and we seem to be inching our way up. To the target that has been activated for the day, which is 1916 on the gold market. $19.16.30 is the target that's been activated as of right now, as the price, by trading above the average that you see here of 1905.40, has activated the sell one target of 1916. This is how systematic and methodical, mechanical the signal is. Now, mind you, I am purposely not mentioning the fundamentals that seem to be pretty bullish fundamentally, particularly when it's coming to supply. Not to mention the monetary relationship, the economic relationship, and the risk asset relationship. The gold market is a pretty flexible instrument that it is, in my opinion, the most real currency for thousands of years that we can count on. And it really kind of establishes the status, you might say, of the fiat monetary system or the economic system. And as we take a look at the economic system right now as a whole, what we're dealing with is a fiat debt based economy. It's not a real economy. It's an economy sustained by debt provided by the central bankers. And as long as I've been around, and you're looking at almost 4 decades, what we saw last March, was pretty much, the Feds opening up the printing presses, the gates of the printing presses, because we entered a whole new different economic dimension, which is the reason why you're beginning to see a lot of money, a lot of cash chasing real assets. What the markets anticipated back in March of last year, the gold market, the equity markets, pretty much the markets in general, after a low of 1167, the market exploded into 2089. This was the anticipation, the first wave in the anticipation, you might say, of what the consequences are going to be by the Feds opening up the printing presses and committing to print unlimited amounts of stimulus, quantitative easing, however they want to call it, devaluing the US dollar. This is what the statement basically meant. That if the Feds or central bankers, and I'm talking now on a global basis, decide to open up the printing presses and create money out of thin air, it's devaluing its underlying currency. It's as simple as that. It's devaluing the assets denominated in that currency. And that's what inflation does. It's a silent killer that eats away at your cash, at your dollar-denominated assets. Even though you may be exploding into, zeros and zeros, they are worthless if inflation is above the rate of return. You're in negative territory, which is really where we are entering here by factoring in just 4.1% inflation or 3.1% inflation, or above the benchmark the Feds agreed to, which is like 2% inflation. We are entering into negative territory with regards to the intrinsic value and purchasing power of the US dollar, or its currency that it is handling this stimulus in its own currency. So we have a momentum going, which is a global momentum going by central bankers that have essentially accelerated the amount of money that is coming into the system. And for all intents and purposes, we're looking at a potential situation just like Japan, where it went into, this doom and gloom economy for 20 years, that no matter how much stimulus it was provided, people did not spend it. They put it in a savings. The money supply exploded. And they went into this stagflation period for over 20 years. So I think it's real to me. It's a real dilemma to see how the Feds are going to get out of the situation, without raising interest rates. According to the Feds, the concern is not basically allowing inflation to run as much as an implosion, once again, of world assets, because they don't have any more ammunition left. The 30-year bond went down to 0.50 basis points, which was negative when you factor in inflation. It's negative rates that you're getting. And to me, raising rates in this environment is really very detrimental to the cost factor of this record debt. So they're caught in a trap. And so we're beginning to see the development since last March of this new virtual economy. And along with that virtual economy, obviously, we have gotten a lot of interest in virtual currencies. It seems to be thousands of virtual currencies being created. And it certainly fits the virtual economy that we're moving into. Now, I want to point out to you that one of the reasons I believe why there is such an interest here, for example, on Bitcoin, and for the purposes of trading, we do trade it, but we follow GBTC, which is the Grayscale Bitcoin Investment Trust. That, I want to be simple, stupid in my trading, and also advise my traders that it really doesn't have to get that complicated with all of this data that's coming out, all this currencies coming out. You want to be careful. The majority of them are not going to last. So you want to be careful where you put your money into. And as far as I'm concerned, in terms of where I put my money is, and at least assets that trade and fluctuate according to the volatility in that market, but also at least have some sense of a protocol of regulation in some sense. And that is what the GBTC does. It's the Grayscale Bitcoin Investment Trust. Now, the other one that we trade is Coin, which is really the Coinbase application that is used to trade all the virtual currencies. So it's an exchange that I think is going to grow as the demand for virtual currencies obviously begins to grow as a consequence of basically the money understanding what is happening to the US dollar, understanding that if we run into heated inflation and it's not temporary, and we go into this 70s psychology again, where pretty much inflation went to 15% and the price of gold followed back to 1981, reaching almost $950, one-to-one par with the Dow Jones Industrial, and interest rates approached, I believe, over 15% in that vicinity. So we are at the opposite end of the curve, and it's very difficult, I believe, where we are, for the Feds to be able to manage this without creating some kind of another economic crisis. The danger of all of this, I believe, is if interest rates begin to rise. And just do some basic math, and if you take pretty much the whole global debt, it's a staggering amount. Our debt right now is exceeding about 110-20% of GDP. I mean, staggering. So the rise on our debt alone of 1% of interest rates, never mind 3 or 4%, if we just go back to normal rates that we had a few years back, or 4 or 5%, it's unsustainable. So what are the choices? What are the choices that we can look forward to the Fed's implementing here? And I think there are very few, outside of making it obvious that the dollar is being devalued silently by the mere fact that they're publishing all of this stimulus, or printing all of this money out of thin air. It's creating supply out of thin air, and it's pretty much negative for the U.S. dollar over the long haul. On top of that, we have this squeeze, you might say, of supplies over the short term as we go back into the economy, as the velocity of money goes back into the economy. We're beginning to see that we're not finding the things that we need. Computer chips, plastics, again, commodities are in short supply. The silver market, there's a huge big campaign of short squeeze supplies. And true, the premiums in the cash market, if you want to obtain silver or gold, are just like real estate. So it seems that we're building another bubble here in terms of the commodity markets, which I believe we could be entering into a period where it could really be explosive for commodities. If inflation continues to show that it's here to stay, at least for the near term, unless again we see some kind of an economic recovery of some sense, really, and that seems to be the argument now, obviously, that we are entering into this explosive economic growth. I think it's overstated. We're entering into an economic growth, into an economy that is basically a debt economy, and we're creating even more debt, supplying the marketplace with this debt that is not organic. It's not solid money. It's government money. It's fake money. It's fiat currency. It's not a real economy. And this is what is upsetting, that when I hear all of these gurus and pundits talk about entering into this world economy, this new world economy, we haven't even yet recalibrated the old economy and have accepted, or at least know exactly what the damage is. It just keeps growing. They're not allowing to see the casualties. And there has to be casualties in this kind of an economy. The government cannot continue to support everybody and everything for indefinite periods of time. It's just impossible. So where are we headed to? It's a real interesting question that I ask myself. And when I think about the possibility that interest rates may spike up first before another decline, which is in fact what I believe is going to happen here as we move into the end of this year. In order for the Feds, in order for the central banks to bring down interest rates again from current levels, they got to raise it. And so inflation is becoming potentially the argument of why the 10-year note interest rates is rising, and it went up to 177. And if we see the 10-year note go through 10%, I think we're going to get tremendous volatility into the market. And I believe what has to happen is I believe that they are going to, at some point towards the end of the year, even sooner, depending upon the pressure of the market, begin to talk about raising interest rates. But in the way that they're not going to mess with the 10-year, they're going to allow the 10-year to run free as wherever it's going to go. But I think the problem is going to be on the 30-year bond. So I really, really think that this is when they will begin to implement yield curve control. And if they do that, realizing that they're caught in a place where they can't raise interest rates, they got to, again, manipulate the market, preventing implosions, preventing, crisis, is very difficult for them to do this now. So I think it's becoming very technical in terms of what needs to be done. And, the bottom line is that interest rates cannot go up, because if it does, then we will see catastrophes. We will see dominoes fall in this economic system. So we're still dealing with a very fragile, economy in terms of where we came from last year, and even I believe worse because of this amount of debt that we got to deal with. So I think we're looking at three major issues developing here over the next few weeks, which is inflation, interest rates, and pretty much where the US dollar is headed for. So you're beginning to see that premium being put into the gold market. You're beginning to see that premium go into the silver market. And also you're beginning to see that premium go into virtual currencies. Because, again, of the fear that the US dollar is on a declining scale. And so when you see that, you run for hard assets. Real estate, is a perfect example. But we're dealing with a dilemma, just on anything here, on top of this development here, that we're running out of short supplies, and that's exasperating, again, the price structure that we're dealing with as far as supply and demand. Obviously, more demand, less product, price is going to go up. And that's what's happening pretty much across the board. So I think, this is not temporary. I don't think real estate's is going to come down anytime soon. Again, unless it begins, or even the market for that matter, unless we begin to see or hear the language changing, that they're getting a little more hawkish in terms of interest rates. I think in the meantime, guys, you want to be able to stay long your core position. Use the VCPMI targets that we have here to manage your profits here. In gold, we're looking at 1916 to 1930 for the day. Silver, we're looking at 28.49, 28.99. I will be talking to you throughout the day in my live trading room here at the Equity Management Academy. In the meantime, if you like what you see, please subscribe. Reach out to ema2trade.com, contact us, and I'll be more than glad to give you a pass to come and see how we trade live here at the Equity Management Academy live trading room. We'll talk to you later. Have a great trading day.